The Federal Reserve just flipped the switch. For the first time since last year, they officially lowered interest rates. And with that, they've put an end to one of the most brutal tightening cycles in US history. For the past 2 years, rates skyrocketed at a pace not seen since the 1980s, crushing everything from housing affordability to tech valuations. But now, that era is over. Here's the crazy part. With the Fed cutting, the money printer is effectively humming again. More dollars in the system, cheaper borrowing, easier credit. It almost sounds like free money, right? But here's the uncomfortable truth. Easy money never comes free. Every rate cut sends ripple effects across the economy, and this one is about to reshape markets, jobs, debt, housing, and even the dollar in ways most people aren't prepared for. So here's what we're going to cover today. Exactly what the Fed just did, what Powell revealed in his latest remarks, how this will shake up your money, and most importantly, how you could actually use this shift to get ahead instead of getting steamrolled. Trust me, nobody is spelling this out like I'm about to, so stick around until the end. Let's start with the obvious question. Why now? On the surface, the economy still looks fairly healthy. GDP is growing. Inflation, while still above the Fed's 2% target, has cooled from its 9% peak. The consumer is bruised but not broken. So why is Powell suddenly pivoting? The answer lies in one word: jobs. The Federal Reserve's job is twofold: keep inflation under control and keep Americans employed. And right now, the labor side is flashing red. The Bureau of Labor Statistics just made the largest negative revision to job numbers on record, over 1 million fewer jobs than previously reported. Think about that. 1 million jobs just vanished off the books. Economists were already expecting a weak revision, but this came in 200,000 worse than even the bearish forecasts. That's not just weak, that's catastrophic. To give you context, it's worse than the revisions we saw during the 2008 meltdown. This is why Powell had no choice but to pivot. For months, he brushed off calls to cut, saying inflation risks outweighed growth risks. But with unemployment climbing, the Fed finally blinked. Critics argue this is too little, too late. That if they had eased up earlier, some of this pain could have been avoided. Others say this proves the Fed is now willing to live with sticky inflation at 3% instead of forcing it back to 2%. Now, let's clear up a huge misconception. When the Fed cuts rates, they're not directly setting your mortgage, your car loan, or your credit card APR. What they control is the federal funds rate. The rate banks charge each other to borrow overnight. That trickles down to short-term borrowing costs and short-term treasury yields. But here's the kicker, the big stuff that matters to you. Mortgage rates, 10-year loans, corporate debt is tied to the 10-year treasury yield. And the Fed doesn't control that. The market does. If global investors believe the US is a safe bet, they buy treasuries, yields fall, and mortgages get cheaper. But if they think inflation's coming back, or Washington is spending recklessly, or the US looks less creditworthy, they dump treasuries, yields rise, and all borrowing stays expensive no matter what Powell does. And guess what? We've seen this movie before. In 2024, the Fed cut multiple times, yet mortgage rates barely budged. In fact, they ticked higher at one point because investors panicked about inflation returning. The same thing happened in the early 1990s and again after the dot-com crash. The Fed can flood the market with money, but if investors don't buy treasuries, the long-term rates that matter most won't come down. This is why Moody's downgrade of US debt earlier this year is such a big deal. They cut America's outlook from AAA to AA1, not because the US can't pay, but because the deficits are exploding with no credible plan to rein them in. Moody's warned that entitlement spending is rising fast, government revenues are stagnating, and by 2035, interest payments alone could consume 30% of the entire federal budget. Imagine that. A third of the budget going just to service debt, not build infrastructure, not fund programs, just to pay interest. That makes treasuries riskier in the eyes of investors. And if investors demand higher yields to hold them, that cancels out the Fed's cuts. In other words, Powell can push down the front end of the curve all he wants, but if the long end keeps rising, mortgages, corporate loans, and credit markets won't ease. And here's the harsh truth. The more Washington borrows and prints, the weaker every single dollar in your pocket becomes. That's the invisible tax of monetary policy. Now let's zoom into the housing market, because this is where most Americans will feel the squeeze. After years of nonstop price growth, housing is finally starting to crack. More listings are hitting the market. Buyers have more leverage to negotiate. For the first time in years, home values are actually lagging behind inflation. Adjusted for rising prices, American housing wealth has declined over the past year, but here's the strange dynamic. The market is splitting in two. Millions of homeowners who locked in mortgages at 3 to 4% during the pandemic have no reason to sell. They're sitting pretty and refusing to move. Meanwhile, new buyers are facing 6 to 7% rates for the same house. That's a massive affordability gap, and it's freezing the market. So, will the Fed's rate cut help housing? Maybe, maybe not. Remember, mortgage rates follow the 10-year Treasury, not the Fed directly. Unless Powell intervenes in the long end of the curve, basically printing money to buy treasuries and force those yields lower, housing could just grind sideways or soften further. That doesn't mean a crash, but it does mean slower growth, weaker demand, and buyers having more room to negotiate. The stock market is another story. In theory, rate cuts are bullish. Cheaper money means higher valuations, but this time, it's not that simple. First, long-term treasury yields act as the benchmark for all risk assets. If treasuries offer 6% risk-free, why would anyone buy a stock hoping for 8% with risk attached? That forces stocks to reprice lower to stay competitive. And right now, long-term yields are elevated. Second, the market is dangerously concentrated. The top 10 companies make up 40% of the S&P 500, with Nvidia holding the largest weight of any single stock since 1981. That's even more concentrated than during the dot-com bubble, when the top 10 were just 25% of the index. Now, concentration by itself doesn't guarantee a crash. Sometimes it reflects genuine earnings power. Apple, Microsoft, Nvidia are money machines, but the speed of this concentration is alarming. The faster it builds, the more fragile it becomes. That's why many are drawing comparisons to the early 2000s, when speculative mania inflated a handful of companies to dangerous heights. So, what exactly did Powell say today? The Fed cut rates by 25 basis points, explicitly citing weakness in the job market. For the first time in 4 years, there are more unemployed Americans than job openings. Powell said this cut is meant to support hiring by lowering borrowing costs for businesses. But here's what stood out. His tone was far more cautious than earlier in the year. He flagged risks from tariffs, inflation, and even technology. In fact, the Fed noted that industries leaning heavily on AI are seeing higher unemployment, since fewer workers are needed to achieve the same output. That's a structural shift nobody's talking about. The Fed also released its summary of economic projections. They're penciling in another 50 basis points of cuts by year end, with more easing likely in 2025. But they also expect inflation to stay above 2% through at least 2028. Translation: they're prepared to tolerate higher inflation in exchange for stabilizing jobs. Markets weren't impressed. Stocks sold off into the close, signaling investors think the Fed is behind the curve. Where does this leave us? The Fed is trapped in a balancing act. Cut too aggressively and they risk reigniting inflation. Cut too slowly and unemployment spikes. The margin for error is razor thin. Here's my personal view. We'll probably see another small cut in October, maybe one more in December. And in 2025, the pace depends heavily on the jobs market. And looking out to 2026, if there's a change in administration, a new Fed chair could easily push for even faster easing. But here's the bottom line. Rate cuts don't mean free money. They mean a weaker dollar, more debt, and higher long-term risks. For you, that means if you're a borrower, this could be your window to refinance. If you're an investor, diversify. Don't get trapped in concentrated bets. If you're saving cash, understand your purchasing power is eroding. This is one of those rare turning points where the rules of the game shift. If you're smart, you can use it to your advantage. If not, you risk being caught flat-footed. So let me ask you, do you think the Fed acted too late, or are they making the right call? Drop a comment below. I'll do my best to reply to as many as I can. And if you found this breakdown helpful, make sure to hit like and subscribe for more deep dives like this. Thanks for watching, and I'll see you next time.